In the past few years, the number of retail investors in Indian equity markets has seen a sharp jump. The rise has been steeper since the outbreak of COVID-19 pandemic in 2020. Market data shows, as of December 2019, India had 39.4 million demat accounts. By August 2022, this had crossed 100 million, and as of January this year, the number had risen to 110 million. This is a jump of nearly 180% in just over 2 years. Much of this has been credited to the success of discount brokerages in India. These brokerages, which carry out a trade on behalf of the investor at little or zero commission, have made trading easier for retail investors in India. Data from NSE shows that in January this year, the 5 discount brokers, namely Zerodha, Angel One, Grow, ICICI Securities and IIFL Securities, accounted for 59.2% of the overall active clients, and they are reporting profits. According to a report by HDFC Securities, Zerodha, the largest stockbroker in India, is expected to make a profit of 2,500 crore rupees in 2022-23. In 2021-22, the unicorn's profit was 2,094 crore rupees. These numbers are impressively high compared to the traditional brokers in India. So, how have they changed the trading game in India? Utkarsh Sinha, managing director of Bexley Advisors, says discount brokerages cater to the rising needs of investment avenues of retail investors in the country.
The disruption in the brokerage industry globally that has been brought about by discount brokerage shops has been a function of the fact that there is finally an ability to meet the demand of the retail investors, which are of a much lower fidelity and of a much lower, servicing quality than for traditional, customers of brokerage houses. A traditional customer would need a speed of execution, would need some certain confidentiality requirements, would need to make sure that there's no front running. There's the need to make sure that there's some a certain level of regulatory compliance, and that their clients' interests are met. When it comes to a retail investor, the bar for each of these dimensions is significantly lower. And the only reason that these individuals could not be serviced earlier was because the technology was not in place. With the advent of internet, with the advent of apps, it was a lot easier to aggregate large scale demand, which from retail investors, and therefore that led fundamentally to the rise of the discount brokerage industry.
Arun Kejriwal, the founder of Kejriwal Research and Investment Services, says discount brokerages use technology to lower costs, which allowed them to cut commissions and book higher profits.
These discount brokerage houses offered an online platform. They had much lower costs because they didn't need huge amount of manpower. They were all system driven, and hence they were able to cut down on manpower costs. This changed the way broking happened in the country. It is this which allowed them to offer cheaper prices.
Sinha of Bexley Advisors says the flow of easy money was also a major reason in the jump in profits of these discount brokerages.
The other key factor that has played a role in its significant acceleration in the past 2 or 3 years has been the availability of cheap money, particularly during the COVID lockdown. There was a lot of stimulus spending that happened globally, and part of that, and the amount of savings that individuals had went up because a lot of the expenditures that they had in traditional categories went down. The combination of these factors led to the fact that there was surplus capital available with retail investors who were looking for avenues to invest it, and discount brokerages gave many of these individuals an opportunity to dabble with the markets.
A large number of trades on discount brokerage platforms are in futures and options. Kejriwal believes these brokerages might see a fall in activity in the coming months as investors have started to face losses in F&O trading of late.
A lot of them migrated from equity to futures and then to writing call options. They have lost a huge amount of money in recent times because money cannot be made part-time and doing these high-risk games. They have now started leaving the market. So it's now a full circle back to zero.
Sinha believes the tightening monetary policy of the RBI will also have an impact on these brokerages.
In terms of the long-term future of such classes, I think as soon as the ease of money flow starts drying up a little bit, as soon as the interest rate regime changes, and it has already started changing, we will see a drying up of excess capital in the hands of the retail investor, and the effect of that is going to be a somewhat slowdown of the discount brokerage industry. I think we should expect to see that happen, globally and in India as well.
Traditional brokerages are also focusing on digital expansion, but not without improving their offline reach.
The focus is surely on digital in a very big way. And at the same time, we have also opened new branches in the last 2-3 years to build our physical presence, because we feel that when a customer has got wealth and wants to invest, he would also like to be in touch with the advisor, may want to visit the offices. So we have got a very good presence digitally, and we have got a very big franchise network, which itself has its own offices across the country.
The discount brokerages have made trade easier for retail investors in India by providing easy access to markets using technology. This has also helped them beat traditional brokers in terms of profits as well as the number of investors. In the coming days, however, they may witness a dip in revenue and profits.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.